to go through chapter 20 in your textbook has some information about the way that companies collect data. So we're staying with the whole financial accounting transactional stuff to begin with here in this course. And so I'm jumping around the textbook a little bit. We did chapters 1 through 4, I guess. 2 was self-study. But now we're going to jump out to chapter 20. So this is chapter 20 in your textbook. So first of all, companies maintain what's called a general journal, where we record every transaction. Now, in modern companies, this is pretty much done electronically. So when you go into the grocery store and they scan your purchases, they're actually posting to their general journal. They're posting debits and credits to the general journal. They're adding cash to the balance sheet. They're recording revenue or sales. They're taking inventory out of inventory, and they're recording cost of goods sold every time you buy something. So a supermarket will have thousands or millions of general journal entries a day. A big chain might have millions of entries a day. So every single transaction gets reported in the general journal. The book of original entry is what the general journal is called. And after being recorded, the summarized entries are entered in the general ledger. So the ledger is the sort of books of the company. And once again, these days, those are all electronic. There are very few people who are posting general journal entries and general ledger entries manually. It wasn't that long ago that people were posting this stuff manually. In fact, when I started in the accounting world, a significant number of companies were still doing manual entries. If you go back a little bit further than that, companies had massive numbers of people doing this manually. Those people are all no longer doing this. The computers do this. Somebody has to maintain the computer system. Somebody has to audit the computer systems, but there's no more manual entry of transactions virtually anywhere. I mean, maybe some small mom and pops do some manual entries, but not many. Even small mom and pops use QuickBooks and post things using electronic methods of recording. So we're away from this, but you and I are gonna journey back in time, and we're going to do a few manual entries just so that we know how the numbers get where they're going. It's important for you to know where those numbers came from. You're not going to be accountants, but you're going to use this information and understanding where the numbers, how the numbers got where they are. How did this show up as an asset on my balance sheet? How did this thing show up as income? And how did it get there? It's important to understand that, because then you can judge the quality of what you're looking at rather than just accepting it as gospel. So we know what the accounting equation is. We've talked about it quite a bit. Assets equals liabilities plus equity, and you can restate it as it is there. Assets minus liabilities equals equity. And accounting is done as a double entry. It's called double entry accounting, because if we're going to change one side of the equation and we want it to stay in balance, we have to change the other side as well. So if we're going to add to some number, we have to subtract from some other number on the same side of the equation, or we have to add to something on the other side of the equation. So we have to make double entries, and that's where your debits and credits come in. So here's an example of a double entry. Let's say we start, before we make this transaction, we have $150,000 in assets, $100,000 in liabilities, and $50,000 in equity. That balances. Got $150,000 on each side of the equation. So we go and borrow some money from a bank. What does that do to the cash side? Well, we borrowed the money, they gave us the money, we put it in our account, we now have $20,000 more cash, so our assets went up by $20,000. We also have something else. We have a liability, we have a loan payable or a note payable. We have to pay the bank back at some point in time, and we have to record that liability. So our liabilities go up. So now we have $170,000 in assets and $170,000 in liabilities. Pretty simple, makes sense. We got something and we gave something up. We got cash and we gave up an IOU to the bank. We owe the money, we're legally required to pay it. So that's transaction one. Let's look at another kind of a transaction. We go out and buy some inventory. We're in the process that we make stuff and we buy raw materials to make stuff. We buy raw material inventory for $15,000 and we pay cash for it. Cash goes down. We gave out cash, but we swapped the cash for a different asset called inventory. So now we're going to collect inventory. So down cash plus inventory, we end up with $170,000 in assets, just like we started with. We just have different assets. We've changed our assets from cash to inventory. The liability side doesn't change at all. So we're still in balance. So a debit, we've talked about this already, but a debit is an increase in an item on the left side of the equation. So debits increase assets, and a credit is an increase on the right-hand side of the equation. So credits increase liabilities and equity, and vice versa. The left side decreases if you have a credit, right side decreases with a debit. Sounds simple. I know you struggle with it. It's normal for you to struggle with it. It's just, you got to get your head wrapped around it. It's a very simple logic system, but you have to understand or get used to the logic system before you can use it effectively. So debits increase assets and credits decrease assets. So that's the green and the red on that side. And on the other side, that's the exact opposite on the other side of the equation. Stockholders' equity, that right-hand side of on the right-hand side of the equation, is actually composed of a bunch of different stuff. It includes contributed capital, so money that people have invested in the company, plus retained earnings, which is the money that the company has earned and kept in the company. So money they've earned that they haven't returned to their stockholders in the form of dividends. So retained earnings is accumulated earnings from the past plus this year's revenue minus this year's expenses minus this year's dividends. So the income statement, revenue minus expenses equals net income, is really part of retained earnings. So you have to think about it that way. You've got this big equation here, and everything is included in this big equation, but there's a subset to stockholders' equity that is revenue minus expenses equals net income. So when you see this graph, which you've already seen once before, when you see this graph, you've got the same stuff we talked about across the top, but under stockholders' equity, you've got two different pieces, and under retained earnings, you have revenues and expenses. And notice revenues and expenses, the signs are the opposite between revenues and expenses. That basically makes sense. If we are increasing revenues, a credit is going to increase revenues. A debit on an expense actually reduces stockholders' equity. So credit to revenue increases stockholders' equity. A credit to an expense decreases stockholders' equity. So that's kind of where we're at. So when you're doing this, when you're posting these manually or thinking about this, you're going to ask yourself, if there's an increase in something, should I record that increase with a debit or a credit? And then the second account has to be the opposite. So if I'm debiting one account, I'm going to have to credit another account. So if you know half the equation, you can probably figure out the other half. And finally, do things add up? One of the problems with debits and credits is that we use the words in general use, and the general use words are the opposite of what they really mean, because we've been trained to think of words like credit or debit from the perspective of the bank or a bank. So when they debit your account, they're doing it on their books and from their perspective. A department store, when they issue a credit, they're recording a liability to you. They owe you money, so they're issuing you a credit, so that's a liability to you. To them and to you, it's not a liability, it's an asset. You've got money coming from the department store. So it's kind of backwards. So we've learned all the wrong things in general practice from what actually happens. So think about the thing you read about the financial language from the New Yorker there. Hey, here's a thing where what actually happens and what it really means is sort of the opposite. So most companies have a chart of accounts that is set up by code numbers. When you work in a company, you will see these charts of accounts. Those of you who are out there in the workforce know this. So your account for expenses for your department might be a 6-digit number. That 6-digit number ties to the general ledger number and puts your expenditures in the right place in the general ledger. So those code numbers are usually, they usually mean something. Assets might begin with 01 and liabilities with 02 and revenue 03 and expenses 04 or something like that. And they usually are, there's usually a departmental code that is distinguishable from the other item numbers in the account number. But just understand that they're there and they are how general ledgers function. So you need to have a chart of accounts. So let's talk about the generation. What do we generate? A balance sheet is a statement of financial position. The financial position at the beginning of any year is identical to what it was at the end of the previous year. So balance sheet accounts start the year with the balances from the prior year. The income statement, on the other hand, consists of revenue minus expenses, and it doesn't start out with any amount in there. So income statement starts out at 0 at the beginning of the year, and then we record the interest. So income statement accounts are considered to be temporary accounts. We add revenue and expenses all year long. We total them at the end of the year, and then we close them out to retained earnings each year and begin the new year with a 0 balance, because the earnings we made this year become part of retained earnings. And then we want to calculate next year's earnings starting with a clean slate. So temporary accounts or revenue expense accounts get zeroed out at the end of every year, and the income or loss is either added or subtracted from retained earnings. So that's how temporary accounts work. Other statements that you see, the statement of cash flows shows where the firm gets its cash and how it's used over the entire period. Statement of cash flows is a derivative statement. It's not a direct statement. So the direct statements are the income statement and the balance sheet. They get transactions posted to them. The statement of cash flows is derived from those numbers. So we want to know where cash came from and where cash went, as opposed to what economic income we generated. Two different things. So the statement of cash flows adds our income, records cash flows plus and minus from operations, investing, and financing activities. Operations are the stuff we do in the normal course of business, the ways we generate revenue within our firm. Investment is long-term assets that we own, so purchase and sale of property, plant, and equipment, and or patents and other intangible assets. Those are investing activities. Those assets are going to last longer than a year, so for accounting purposes, we consider them investments. Some companies buy long-term investment securities, but generally companies don't do that. Most companies are in the business of conducting their operations, and if they have free cash, they probably invest it short-term or return it to their shareholders. They don't invest it long-term in other companies. So investment securities for most companies aren't there. However, financial companies have lots of investment securities. So banks, insurance companies, investment banking companies, all of those kinds of things may often have long-term investment securities because they're in the financial business and that's part of their business is owning long-term securities. If we lend money and then receive payments back, that's also an investing activity. So financing activities, getting money from outside. So when people either lend us money or they invest in our company by investing in an equity interest, they buy our stock. Those are financing activities. Those are on the plus side, cash sources. We also may pay out dividends. That's a minus to invest financing activities, or pay out funds to repurchase our own stock. That's a negative. When we borrow money, it's a financing activity. If we pay back that borrowed money, it's a negative to that financing activity. We also have to make adjusting entries to adjust accounts to the correct amount as of the statement date. They're internal entries. They're not triggered by external transactions. So we have to record prepayments and maybe the use of prepayments and accruals as well. So we'll talk a little bit about those later. I'm not going to spend a lot of time on that now. So I've got a couple of financial statements here to look at. So there's a balance sheet. We've seen plenty of those already. You've got your assets at the top, current assets first. So total current assets of $86,000, fixed assets of $54,000, total assets of $140,000. Then below you have current liabilities. Those are liabilities we're going to have to pay within a year. It's $20,000. We have a long-term liability, a mortgage payable of $36,000, total liabilities of $56,000. And then we have stockholders' equity composed of stock and retained earnings, $84,000. So total liabilities and equity are $140,000, and total assets are $140,000. So that's your balance sheet. Income statement, we had revenue of $56,000 this year. We had a variety of expenses that added up to $52,000, and we end up with net income of $4,000. You also see this statement of stockholders' changes in equity, stockholders' equity, which just details what happens. So during the year, we started out with $10,000 in common stock and $73,000 in retained earnings. We ended the year with $10,000 in common stock, so nothing happened. Don't have to record anything, or don't have to put anything there because nothing happened. However, retained earnings changed from $73,000 to $74,000. How did that change? Well, we earned $4,000 and we paid out dividends of $3,000, so that accounts for the change. So it details what happened, whereas if you go back to the balance sheet, it just shows retained earnings of $74,000. Here you've got a detail of how did we get to $74,000. Informational. And then the cash flow statement, we generated, or actually we used $28,000 for operating activities. So we got money from customers, we paid employees, suppliers, insurance, and interest. So we had negative cash flow from operations of $28,000. Now remember, we showed a profit of $4,000, but we've used $28,000 in our operations. Cash flows from investing activities, we didn't have any investing activities, so we don't have any cash flows. And cash flows from financing, we paid back $4,000 on our mortgage, we paid $3,000 in dividends, so we used $7,000 in financing activities. So our cash went down $35,000. We started the year with $52,000, and now we have $17,000. So that tells you it's a different story from the income statement. The income statement tells you the transaction story, $56,000 in revenue, $52,000 in expenses, a $4,000 income. However, we bled some cash. We used a lot more cash than we took in. So our cash balances went down, and here's where we used it. So that's basically how a cash flow statement works. Following this lecture,